Well, greetings and welcome to our next investment strategy brief. This is actually going to be an episode, if you will, for July and August 2024. And as we thought about how we wanted to put together this presentation, we were thinking back to our outlook where we talked about embracing change. And really, there's in some ways kind of two major things going on. What we think, a market rotation that's happening, and then, of course, the U.S. elections. And so the idea of embracing the change that's coming, honestly, we also think there will be a bit of a shift in the economic environment. So anyway, that's the topic of our session today. So let's jump into it. Starting with the economy, as we've discussed the last number of months, basically, global GDP has been strengthened by the optimism around artificial intelligence. And as we've discussed before, there's estimates out there that it's in the trillions and trillions of dollars that the economy is going to be improved by artificial intelligence, let's say by 2030, some numbers in the $15 to $16 trillion range, both as it relates to improved productivity as well as product enhancements. And that's driven a lot of stocks higher, NVIDIA being the ultimate example of that, it being up quite a lot and representing quite a lot of the S&P's overall cap-weighted return. And in this episode, we wanted to include almost like a quick sampling across a variety of industries and sectors of the kinds of things that are being influenced by artificial intelligence. So if you think about financial services, it could be things like fraud detection or loan underwriting. In the area of healthcare, it's things like genomic analysis or drug development. In retail, we all know about personalized shopping and what feels like is coming, automatic checkout. So conveniences and innovation, really, as it relates to artificial intelligence. And so that's been a real tailwind to the environment. In fact, we just recently got the first estimate of second quarter GDP that came out at an annualized rate for second quarter 2024 of 2.8%. And that's above what was already a somewhat elevated consensus view that it was going to be 2%. And so that's a better than expected number, and it does acknowledge and sort of represent that in the first half of the year, kind of like last year, we just had economic results a little bit better than expected. And yet, as we'll get into here, we do expect there to be a bit of a shift and a slowdown in the economy. And so as it relates to why that's the case, I mean, let's start in with sort of interest rates, Fed policy, and inflation. We've seen inflation cool down as it relates to the consumer price index and a recent print for what's called the PCE. Now, the producer price index, or PPI, was a little firmer probably in this most recent print than the Fed would like to see. In any event, I would say just generally, inflation is down month over month for a month or two or three, about at the level the Fed wants to see. And so the speculation is, when is the Fed going to start cutting rates? And the reality is, the sort of the debate that's going on probably about the Fed thinking, but probably also within the Fed, is how long do we want to see this good evidence, right? And so as it relates to sort of where the Fed funds rate's going, the Fed keeps signaling they're going to take time. They want to see evidence that inflation's headed towards its 2% target in a reliable way. And so, punchline is that they keep signaling it's going to take some time. But when it comes to the market views, essentially the market is actually pricing in 100% probability of the first quarter point cut from the Fed at the Fed's September meeting. We actually don't think that's necessarily going to happen. We think it's more like December. But the market's pretty optimistic about that. And I'd say the Fed's not saying yes or no. They don't do anything till they actually have their meeting and make their announcement. So we'll see how things unfold both at the July and the September meetings. But ultimately, we think that cuts are going to come a little bit later than in the year. Now, that short end of the curve and rates in general have been elevated in good part because of the Fed's current tight policy and where the Fed funds rate sits. And just remember, one of the headwinds we're mindful of is this idea of fiscal transition. With all the buildup of debt, coupled with these higher rates that are expected to be higher for longer, that's basically telling us, hey, the consumer, businesses, and government are going to have to deal with the higher cost of debt. And so that's something that's in real focus. And as we analyze the data that we analyze, we're really watching the consumers. So as we talked about last time, We have quotes from CEOs during earnings calls for companies that are focused on the consumer, quite a number of them talking about things slowing down or the consumer feeling a little bit of stress or whatever it might be. And actually, as we start to look at the data, we see things and continue to be in the area of sentiment and confidence, numbers that sit below the long-term average. So the consumer is signaling a little bit of concern. When it comes to retail sales, the numbers are bouncing basically below the long-term average. And then when it comes to debt, we've seen a marked increase in the cost of debt for consumers on non-mortgage related debt. And that, of course, that's usually variable debt. So think credit cards, autos, et cetera, and credit cards for sure. And then the mortgage market, where the rates are often fixed, it takes time for that increase to occur because it relates to somebody either paying off their mortgage to move, or they paid off their mortgage, they got to get a new mortgage, and it takes time for those rates, the average rate, to change as people more slowly turn over their mortgages. And so anyway, the punchline here is the bottom right, which is we're seeing some stress, right? The costs are going up, so there's an increase in delinquencies on debt like credit card and autos. And so again, something that we're watching, and sort of evidence of a consumer slowdown. In any event, what we're expecting is for the second half of 2024, for the economy to stay positive but get a bit more slow. And you can see the consensus estimate, that green line at the top. If you move over towards where it says Q3 2024 and Q4 2024, the number is 1.5. That's sort of the market consensus view, that we're definitely moving down from 2.8% in everyone's view. Our view is it could go a little bit lower than that, but we're not overly worried about a recession, or at least a severe recession. And all of that's going to play into sentiment and the markets, which we'll get to in a couple minutes. Now, a second section that I want to get into is the elections. So, basically, we know that we're sort of on this path where we've had the Republican National Convention. It was a very energized event in the wake of the failed assassination attempt on former President Trump. Then we've got Biden basically withdrawing from the race, Kamala Harris looking to be the Democratic candidate. And so the Democrats have to navigate, I'm not sure if this is an issue for them, but an Ohio law that might require them to certify the ticket before or by August 7th. In any event, they have their convention on the 19th of August. And ultimately, there may be some debates later after that. Then we have Election Day. Then the Electoral College formally votes in December, and then Inauguration Day on January 20th. But one thing I wanted to say here is through different sort of reasons, right? One being the failed assassination attempt for the Republicans. And in the case of the Democrats, basically Biden deciding to withdraw, Harris looking to be the person on the ticket. Both parties are essentially coming together and seem to be more unified. And so in the case of Republicans, it's obviously around populism, or the idea of wanting to appeal to ordinary Americans, to their concerns and their interests, rather than the elite. And really with an emphasis on nationalism. So, with that, a lockdown on illegal immigration and at a high level, economic policies intended to spur growth and protect American jobs. On the Democratic side, especially with Kamala Harris likely to be on the ticket, basically it's a focus and a rally around progressive values. So emphasizing social justice, economic equality, government intervention really to influence things like energy policy, renewable energy, et cetera, as well as increase taxes on the wealthy as a way to fund social services for the broader population, like universal health care. So again, some coalescing and unity, if you will, on both sides of the aisle when it comes to this election. In any event, I think the story plays out similarly this year in the sense that there are a number of states that are essentially likely or otherwise locked up by the Republicans. Similarly, a number of states likely are locked up by the Democrats, and then the classic battleground states. The election in some ways is going to be fought on the presidential side in those battleground states where right now, and we'll see some data in just a second, Trump seems to have an edge. As it relates to Congress, of course, the House will be recontested. The Senate, it will be a few more seats up for election that are currently occupied by Democrats. So from that perspective, maybe it's a little bit advantage Republicans, but we'll see. In any event, the models that predict what might happen have been very interesting. Basically, in the wake of first, I'd say President Biden's performance at the debate, and then around the failed assassination attempt of former President Trump, basically the probability of a Trump victory kind of moved up above 60%. And it's come down since then. But what you can see on this blue line is the probability of Harris winning the ticket, and obviously it was close to zero because she wasn't going to be on the ticket, and now it's basically moved up. And so the punchline is that right now Republicans have an advantage, but we have to wait and see. I mean, I always say, hey, if it's 60-40 or 65-35, 35 or 40% chance is a big number, right? It's almost like, is there a 30% chance of rain? Once it's raining, it's 100%. So it definitely can happen. And so, it's hard to really know for sure. One other point that's pretty interesting, this chart on the right, the highest probability scenario across the presidency, the House, and the Senate is for a Republican sweep, but you can see that the probability of that dropped from just over 45%. That dot represents the day before the debate, actually, and it dropped down to basically currently about 35%. So again, leans Republican, but it's anybody's guess as to how this is all ultimately going to unfold. So one of the things we like to do, of course, is to sort of parse what's happening. And I'll mention this again in a moment, but we're going to have a client webinar. So we'll be providing a link in our notes to this video. And so if you hit that link, you'll either get an invitation or you'll be presented with the replay. In any event, I want to get into some components, if you will, of the platforms between Trump and Harris. First, when it comes to taxes, we would expect President Trump, if he's reelected, to continue the 2017 tax cuts and possibly bring rates even lower. If Harris is elected, we would expect, not likely an extension, but maybe an extension for a very small group of lower earners. But ultimately, the focus is going to be raising taxes on companies, and let's say taxes on realized gains or corporate buybacks. And the punchline is they want to raise money, right? As it relates to the environment, I would say an unwinding of things happening in the current administration if Trump is elected, and a doubling down as it relates to clean energy and things like that if Harris is elected. And when it comes to healthcare, it's sort of like free market from the Trump perspective, government provided from the Harris perspective. When it comes to foreign policy, I would say Trump has a decided focus on America first, whereas Harris probably is a little bit more status quo and sort of a variety of multilateral agreements around the world. And as it relates to China specifically, both will be tough on China. Trump has obviously talked about really increasing tariffs, whereas Harris will kind of keep the status quo in that case as well. When it comes to regulation, we should expect a bit of deregulation if Trump is elected, with a focus on sort of making the government a little bit smaller and kind of simplifying things, whereas a president, Kamala Harris, would basically increase regulation, especially in areas like energy, technology, and financial services. In any event, interestingly, back to that fiscal issue, essentially we would expect both parties to continue deficit spending, whoever's elected. So we'll see how that unfolds. As it relates to market implications, you can think in terms of potential tailwinds and headwinds. If Trump's elected, I think there's tailwinds for traditional energy as well as financial services and defense in terms of increased spending. And then I would say companies that are focused on producing here in the U.S., including small businesses, and sort of onshoring that might happen into the U.S. Headwinds for a Trump administration would be companies that are significantly tied to China and dependent on China, and then those kinds of businesses that have been established to provide renewable and clean energy. On the flip side, if Harris is elected, we believe the administration and the government would double down on renewable and clean energy, so even more opportunity there, including electric vehicles as another sort of spin-off of that. And then ultimately, probably continued support of higher levels of immigration, and so certain industries that might take advantage of that in terms of workforce and keeping wages low might benefit. As it relates to headwinds, if Harris is elected, those increased regulations on financial services means there's going to be some pressure there, as well as things like technology, where there'd be continued and maybe increased scrutiny on mergers and acquisitions. So, as it relates to the market behavior generally, this chart's super interesting. Think of each line, some of them are kind of very light. It's a different market pattern before and after an election. And what we would point out is, firstly, of course, every market's different. There's a lot of other things driving the market right now. But just in general, just to offer some general observations, it's often the case that the couple of months before the election, the market gets a bit more volatile. And then after the election, things calm down, and on average, stocks tend to go up. And so, again, you can tell by all the different lines on this page that may or may not happen this year, but it's still important to at least understand what those average patterns might be. Anyway, as it relates to this election, we will have a few webinars between now and up to the election, and then probably one right after. But the first one is coming up on Tuesday, July 30th, as I record this. So again, in the slides for this video and the notes for this video, we'll put the link to the webinar. So please join us either to view it live, or if it's after the fact, to watch the replay. All right, switching gears, I want to talk finally about the markets. First up is interest rates. Basically, one thing that's very subtle, but I'll kind of point it out. You can kind of see this on this chart, which is the bottom line is sort of where rates were during the pandemic, and you can see an upwardly focusing treasury curve, and then you can see the goldish one, if that's the color. It's kind of inverted. The high end is much higher, and it kind of takes a bit of time get out to the 10-year before it starts to flatten out. The one sort of in the middle at the top is roughly the current yield environment, and what you can see is from about 5 years out, we have a more normal and positively sloping curve. So what everyone's kind of waiting for when it comes to interest rates is for the Fed to start to cut. And when that happens, that short end is going to start to come down as the Fed hikes, and maybe a little bit in anticipation of that. And the punchline is we end up, hopefully, with a more normally shaped yield curve. And that's just sort of a healthier environment for bonds, if you will. In any event, as it relates to where we are today, across the various categories that we tend to look at, yields remain very elevated. That means that for forward-looking investors, it's a good time to be taking a look at bonds and investing in bonds if you're putting more money to work. If you've held back on putting your held in cash, maybe some money that you otherwise want to deploy back into fixed income, it's a really good time to do that. One of the effects, not to get in too much into the detail, is that rates start to fall, as I alluded to. If that happens across the yield curve, maybe the short end comes down a little more, but the whole curve comes down a little bit. That ends up affecting the prices of bonds. The longer the bonds, the more traditional the bonds in terms of maturity, there's typically a price bump for that. And so again, not a huge market timing call, except to say if you have money in the short end, it's a reasonable time to start to almost like dollar cost average, a little bit at a time back into the bond market. Now, as it relates to equities, we're going to talk in a second here about a rotation, but the bottom line is on a cap-weighted basis, the market remains a little bit overvalued, about 20% of a premium to the 10-year average of price-earnings ratio. So I want you to remember that. The PE is up a little bit. Now, just to be clear, when we look at it on an equal-weighted basis, it's actually operating roughly about even, and that means the bigger companies have been the drivers, as we've talked about, the big tech-oriented companies. And so one of the things we wanted to look at this time is to look at how the price earnings increase, which we just talked about, is contributing to returns. So this is basically a bar chart that breaks the total return of the market into three pieces: the dividends being paid, basically that expansion of the multiples, prices going up, and then whatever earnings growth is basically experienced. And you can see in 2023 and 2024 that earnings growth is a little more muted, but the earnings or multiple expansion has been significant. And so, especially in 23, you can see earnings growth down near zero. Some measures are showing it as a little bit positive, others a little bit negative. I think this graph would reflect just a little bit of negativity. But that PE expansion is really the market's way of saying, hey, we're optimistic. We're optimistic about the future. And so, again, something to be mindful of. And it's not something that continues forever, right? So it's something that tends to pause or comes back a little bit. And that's one of the influences that we are mindful of as we think about the market. As it relates to earnings growth more broadly, interestingly, when we look at the forecast for growth in the latter part of the year, this happens to be fourth quarter, we can see non-tech oriented sectors that are setting up to generate some better earnings. So financial services, for example, financials, healthcare is another example, materials, yet another example. So a broadening out of earnings growth, and that's sort of started to be seen in the market in terms of performance. And in fact, when we look at performance, for a long time we've been talking about what really is almost like the 2023 and then the column second to the right. This idea that big tech-oriented stocks like the Magnificent Seven, or is kind of reflected in the FANG Plus Index, have been driving stocks higher. They're big companies, so they're influencing that top line, the cap-weighted S&P 500. And we've been talking about the potential for a rotation. And I've written a couple articles on that over the last few weeks. And the punchline is on July 10th, for now at least, that marks the shift, that marks the rotation. So what do we see from there? We see the Magnificent Seven stocks maybe giving back some of that PE expansion a little bit. So those are down almost 13%. And you see the cap-weighted index, which has been everybody, in this case the S&P 500, everybody's favorite, is down a little over 4%, but that equal-weighted strategy, just over a couple of weeks, is up 1.3%. So again, the data is sort of showing us this kind of rotation that we've anticipated. You never know, of course, exactly where things are going to go from here, but we've been talking about it setting up for that, and it seems to be going just that way for the time being. Now, as it relates to that pattern, what's in favor, cap-weighted or equal-weighted? As we looked at in the last episode, basically these things tend to come and go in and out of favor over a handful of years, 1 to 3 or so years. And so we've been in this period where the cap-weighted index is dominating, but we could well be setting up for a period when it reverses, and once again, the equal-weighted strategy sort of performs better. Now, why is that important? It's important because it's very often the case, especially for clients that and investors that are invested in an active management sense. It's a common thing for active managers to be equal weighted in their strategy. And so just that's been a bit of a headwind. And so you hit these sort of short periods where almost like structurally you're sort of wrestling with underperformance compared to that cap-weighted index. And sometimes people will capitulate. But boy, when you do, if you miss that rotation, that's when that can spell trouble. So the bottom line is we would expect active management in the wake of this rotation to start to show a little bit stronger results as a result of that structural shift, that rotation away from the cap-weighted to the equal-weighted. So, bottom line is you don't want to get disappointed by short-term underperformance, capitulate and change, and have unintentionally rotate into something that's about to become less in favor. That's a challenging thing as it relates to how investors might operate. In any event, to sort of close out here, as always, we'll just mention that we're monitoring a lot of information. I mentioned that we're sort of focused in on the consumer and a slowdown in the consumer. We're obviously focused in on the election and where that goes, and watching the dimensions of this rotation to see how things unfold as we engage clients. I'd invite you, as always, to check out stifelinsights.com for this video and a bunch of other stuff. And with that, thank you so much for watching this session, and we'll see you actually in September. Thank you.